Now, the IMF's World Economic Outlook in 3 presentations. The first, entitled The Global Outlook, will be presented by Gian and discussed by Jason.
Warm thanks to GW for the hospitality, for organizing this event, and to Jason for accepting to discuss this. My presentation is going to be a little bit different from the World Economic Outlook we released in April. And the reason is that we are about to issue an update of our global forecasts. I did not want to bore people with, numbers and tables that, given the fast-moving global environment, are out of date. At the same time, I cannot really share numbers that we haven't published yet, but I want to give you a flavor of how we're thinking about the performance of the global economy and, the enormous sources of uncertainty surrounding everything that we are going to project. I put there a slide. I hope you can all see it. Let me try again, share my screen. Can people see the slide? Okay, so I have put a roadmap there, and it is a bit of a roadmap of the presentation and a bit a list of the reasons why we're going to be wrong, no matter what we're trying to, what the projections are going to look like, the enormous sources of uncertainty surrounding them. Let me start actually moving forward one slide and then moving back, because I want to give you at least a flavor of what we said during the month of April, and that is, let me try to change my slide and see if I succeed. Okay, so this slide, I hope you can see it, has our path for global GDP in our forecast in April. And those are the lines, the firm lines. The dotted lines where we think things would be in just at the end of January prior to the pandemic. And what you see is this very sharp downward revision, and in particular, a very dramatic decline in GDP. And you see it happening in the first quarter, in particular in China, that's the yellow line. And during the second quarter, it was projected to happen in advanced economies and slightly less severely in emerging and developing economies, with a recovery more rapid in China than elsewhere, that would still leave us quite below the level of GDP, the trend of GDP that we were forecasting in January, even by the end of 2021. So this is fundamentally where we stood, where we started. Now, what has changed since then? I have moved back one slide. And what has changed is, of course, we have learned more about the depth, the severity of the downturn for the global economy, which in China really started at the end of January. For the rest of the world, the collapse in activities really in March and continuing to its trough in April. What we have is the numbers that have now been released by most countries for the first quarter of 2020 tell us a picture that is on balance in line with our forecast, but even a bit grimmer than that. And that is the first reason why we're going to revise our global forecast down compared to the ones we released in April. The second thing that we have are, of course, data for the second quarter, which is still in the form of higher frequency indicators, and they all point to the world economy really troughing during the month of April, and activity showing a little bit more life during May, but still way, way weak. And we had massive policy reactions, particularly in advanced economies. both on the monetary policy front and on the fiscal policy front. And of course, we had an evolving dynamics of the pandemic that I will discuss with the follow-up slides, and a pattern of lockdowns and reopenings. One last feature I want to mention relative to what has changed since we finalized the April wheel has been the tone in financial markets. I would say, despite the fact that if you want, on the data front, the data have been remarkably weak, we've had a dramatic change in tone in financial markets with a really panic wave setting in during, and a lot of volatility during particularly the period from March 10th to towards the end of March. A period like that has now been replaced by a gradual increase in confidence on an economic recovery, also spurred by very aggressive actions by the main central banks, very appropriately aggressive actions by the main central banks, to the point, though, that the rebound in market valuations looks somewhat disconnected from the still very severe macroeconomic situation. We hope that the improvement will validate those optimistic market assessments, but this is a question that will remain to be, this is something that will remain to be seen. And I have listed on the roadmap just the extent, some elements of the sources of uncertainty. We are already pretty bad at forecasting global economic outcomes. We know that. The mistakes that we make are quite significant, even when we are forecasting growth for the current year, or even more for the next year. Add to those the general sources of uncertainty, the fact that there are sources of pandemic uncertainty, which will matter enormously for output developments, on which really, we just lack precedents to be able to attribute really probabilities to different types of outcomes. And I've listed a number of them there. I'm happy to come back to them as questions are asked. With the decline in activity, we've had a sharp decline in global trade. I'm mindful of time. I'm not going to spend a lot of time on these slides, and people are welcome to follow up on individual ones. And I have now a couple of slides on the path of the pandemic, not because I want to be an amateur epidemiologist, but just because those things are actually quite important for how we look at the developments on the macro front. The first slide has, on a logarithmic scale, cumulative confirmed cases on the left-hand side in advanced economies, on the right in emerging economies. And I think a more sort of informative slide to tell you where things stand today is the next one, where we look at new confirmed cases also on a log scale. And fundamentally, the message is the following. In most advanced economies, but I would say early on, particularly Korea and Japan, that were able to contain the pandemic, but most recently in particularly Euro area countries severely affected, Spain and Italy, but also Germany and France, the pandemic was contained to a much, to a very, very considerable extent, to the point that new confirmed cases are really declining very, very sharply. I'll give you just one idea for my country, which was hit horribly by what has happened. It was a dramatic set of developments that are, really shocking. We had in March, towards late March, over 4,000 people in intensive care, and of course, scores more hospitalized. The number of people in intensive care now is around 200 for the country as a whole. This is to give you a sense of the declining infections. So I would say on the epidemiological front, overall good news for advanced economies, a bit less for the US, where Certainly, containment measures were less draconian than in Europe, where there has been more anticipated reopening in many states, and where cases are unfortunately not dropping as rapidly as elsewhere. But it is in emerging and developing economies where, unfortunately, we have seen in certain areas the pandemic really getting worse during the past couple of months, and Latin America is a case in point. And you can see it from the right-hand side chart that clearly shows that the path of new confirmed cases, with the exceptions of a few countries in emerging Asia, does not show the pattern that we see for advanced economies. To give you a sense of the trough in activity, here are data on industrial production for a bunch of countries, large countries, as well as data on retail sales. These data are available until April, which was the trough. But just look at the scale and you get a sense of the developments of the dramatic decline in activity that is occurring during the second quarter. I have one more indicator. Those are PMIs, which separate out manufacturing from services. Traditionally, recessions see a collapse in services, in manufacturing activity, much less so in services. This is not the case. This is a different crisis, as Gita says, is really a crisis like no other, because of the hit to contact-intensive activities, to travel, to restaurants, to hotels, to sports. You see a massive contraction in services. We see things becoming a little bit less bleak in May, but of course the levels of activity remain extremely, extremely weak. China is a bit of an exception, again, because China had a peak in the pandemic way earlier than other countries. And still, the recovery, is proceeding, I say, more rapidly, where you can ramp up activity more easily, which is in manufacturing, but demand for services is picking up, but it remains weak also because, of course, you can crank up the supply capacity, but you have an increase in social distancing, and demand for these services is still down very considerably. There is a lot of debate on the intersection between the demand and the supply side of this crisis. I have one chart on inflation, and that tells you that overall price pressures have been extremely, extremely weak. Inflation is falling across the board. And of course, the dramatic decline in oil prices, especially earlier in the year, is an important factor, but not just that. There is clearly a dramatic hit to aggregate demand, and inflation is really dropping very sharply. I mentioned before that countries are in the process of gradually opening up. On the pandemic front, the good news, again, for those advanced economies in Europe that have reopened, is that quite some time has passed since the beginning of reopening, and the pattern of infections seems to remain under control, even more so than people were forecasting when the reopening started. It's very difficult to forecast these things because we can look at what is happening to mobility compared to pre-crisis, and this is how many epidemiologists had tracked the forecast, had made forecasts on what would happen to infections. But you have a lot of changes in behavior, which are much more difficult to model, and from masks, just from the social distancing, from the fact that older people are not really leaving their homes much, that social distancing is prevalent, that climate is helping, at least in the dimension of having more outdoors activity where infections are much less likely to happen. All those things have implied for some countries a reopening that so far has run relatively smoothly, albeit still with weak levels of activity. But again, unfortunately, this is not the case across the board, and some countries, including in Latin America, are reopening in a situation where the pandemic is still not under control. These are extremely difficult trade-offs to navigate, particularly in countries that are poorer. So I'm not casting judgment on decisions that have more to do with public health, have to do with public health and economics at the same time. But clearly, if you are trying to forecast the path of the pandemic, how it might affect activity, you need to take these things into account. Let me close with this one slide on considerations that we take, that we had to, think about for the forecast. And, there are considerations that really apply to what we are thinking about the recession this year and the pickup next year. And there are considerations that are crucial in thinking how will things play out over a longer time horizon. And again, the uncertainty along particularly the latter dimension is extremely high. And here are a few questions. One, which we will be able to answer better probably by October, when we'll have complete data on the second quarter of this year, which was the peak of lockdowns, is how does the pandemic and lockdown, how do they interact with the structure of the economy? And in particular, do you see, of course, more severe hits in countries where contact-intensive sectors are more important? The answer is going to be yes, but we're going to get more evidence on the extent to which this is the case. We will, of course, have to think how persistent social distancing will be. And of course, that will, we think, depend crucially on the path of the pandemic and also on the speed with which both treatment and vaccines are developed. What is the risk of a second wave of infections? This is something that both virologists and epidemiologists stress. It is clearly very possible that this will happen, particularly as, again, climate reasons in the northern hemisphere imply, again, a move towards more indoor activities, and the reduction in restrictions imply an even further increase in mobility. This is a big question. We hope this is not the case, but this is clearly a possibility. And another set of issues is the extent of scarring and the impact on productivity that this crisis generates. The scarring can occur through a variety of channels, and there are we fear some sectors which are particularly employment intensive may have to be weak for a protracted period of time. That would require substantial reallocation of resources across sectors, substantial, particularly in terms of labor. And given, again, the characteristics of this pool of workers, it is not going to be easy to reabsorb, some part of the increase in unemployment. And of course, the more persistent this reduction in employment is, the more all the channels that you all know well, attrition of skills, people discouraged, mismatches, all those things can prevent a recovery from really allowing a return to those unemployment rates that we had seen just a few months ago. And of course, what is going to happen to the connective tissue of the economy? Governments have done a lot, particularly in advanced economies, to keep that connective tissue alive, to help small firms, to retain a link between workers and firms. But of course, an issue remains as to for how long this will happen and whether certain sectors will really not experience a more persistent shock that will require a massive structural adjustment. And the last thing I would say is, of course, on policy support, it's been very strong. It's been essential during the lockdowns. It is something which may have relatively low multipliers during the lockdown, just because people cannot spend that much, but would have enormous multipliers on the recovery. If you don't do that, you really risk bankrupting a large share of your economy, and then the recovery is going to be a disaster. So that action was absolutely crucial, but the policy support may be needed for much longer. And with countries in many cases outside advanced economies, very constrained in terms of fiscal space, that is going to be an issue. Let me close here and happy to take questions after Jason's discussion. Thank you very much.
Thank you, John. I wanted to remind our audience that now is a great time to formulate some questions and put them on the Q&A device on WebEx. Thank you very much. Jason.
Great. Thank you so much for having this discussion. I can't believe I'm overdressed compared to the IMF. In my defense, I was on Fox News earlier, so I want to look good. Look good for them. This is the third time I've been invited to discuss a chapter from the WIO for the release of it. I think the last two, I actually discussed the chapter when I did the discussion, which means at the end of today, I will have a batting average of 667 when it comes to actually discussing the chapter that I'm supposed to be discussing. I thought chapter 1, I read it when it came out. It really helped inform my thinking about what was going on, at the global level and my understanding. John Maria, though, begged and pleaded with me not to use any of the numbers in my discussion today. And so it's really because of him that I'm forced to show you just numbers from the OECD and not the IMF. Let me start with the overall framework I have for what's going on. This is very similar to the time path of output in the IMF forecast that John Maria shared with you. So I think this is fully in sync and just the way I think about it. It's 3 economic phases. The first phase is the collapse. This happened within the space of about 2 months at a global scale as countries went into lockdown and as individuals in those countries chose to social distance. There's a debate and a question about how much of this is due to the policy choices, how much of it is due to individual choices. Obviously, both of those are mutually reinforcing, but ultimately, most people think this was important to have done for health reasons and a good thing. Phase 1 of the recovery is the partial rebound. It's a period, and you saw this in Jean Maria's charts, of very fast growth. It's very fast growth because furloughed workers are going back to the firm they were furloughed from, or firms that weren't selling stuff reopen and start selling stuff. It's a very easy form of growth. It's the type you see after a natural disaster, and that will get us some part of the way back. The question is, what fraction of the way back does this get us? That's a very open question, and it depends a lot on how much of what we're seeing is a reallocation of labor versus a just stop-start. It depends on how much we're seeing solvency problems versus liquidity problems, and the like. Phase 3 starts from phase 2, but it's a smaller slope. I call it the slog. So in phase 1, in a country like the United States, where furloughed workers are counted as unemployed, you might see the unemployment rate fall by 1 percentage point per month during the partial bounce back. During the slog, that is the normal business cycle dynamic, where people are finding new jobs in potentially new sectors, new businesses are being formed, businesses are being growing. All of that is much harder. And so instead of the unemployment rate falling by 1 percentage point per month, it might fall by something closer to 1 percentage point per year. This raises, I think, a number of questions, and I want to highlight 4 of them. Trigger warning, the first 2 of these at least are going to use OECD data, just because it's a little bit more up to date than the WIO, which is coming out soon. So this is from the OECD's economic outlook from yesterday, and it shows the growth rate in the first half of the year for G7 countries. This has a forecast. It has all the forecasting errors that Jean Maria talked about, but a lot of this forecast is based on time that's already elapsed. 5/6 of the time reflected here has already elapsed, so there's a little bit less guesswork. You see a big variety in economic performance between Japan and France, where the difference in reduction in GDP is a factor of 2. What does this mean? The United States had a smaller output reduction than any of the European countries. What can we tell from this? Normally, we would say a smaller output reduction was an unadulterated good. In the case of the United States, it was in part due to the large fiscal expansion here compared to the other countries you see to the left. Some of it may be a smarter lockdown. Construction, for example, is a relatively safe activity compared to the amount it contributes to the economy. That continued to a decent degree in the United States. It halted to a decent degree in Europe. Some of it, though, may reflect a worse lockdown. And the United States, and you saw this in Jean-Maria's slides, is emerging from this with more cases and cases that are not falling at anywhere near the rate you're seeing in Italy, Germany, and France. And so that means the higher output in the United States relative to those countries may come at the expense of lives and may come at the expense of GDP in the second half of the year. The lives obviously much more important, but it might be that France and Italy made an investment in coming closer to crushing the curve to have better economy later on. And the United States had a better economy up front, but prolonging the pain. I view those all as open questions, but very important ones. The second question is employment growth in 2020. The exact specifics of this forecast are not that important. What you see, and you see this in the IMF numbers too, the important thing is that the number is much larger for the United States than it is for any other country. And so you see the United States has looks like it might have a smaller reduction in output and a larger reduction in employment. Now, one possibility is to celebrate the productivity of the US economy, and it's much more productive than anywhere else. But that's probably not the right response to this. Europe has institutions that, Germany at least has institutions that appear to be capable of allowing the reduction in GDP to be spread across more workers. And so you get more part-time employment, less reductions in employment overall, and that puts you in a better shape for a labor market rebound elsewhere. France, the UK, and other countries, Italy and other countries, I'm not sure about Italy, have adopted policies where rather than unemployment insurance, unemployed workers continue to be paid, non-working employees continue to be paid by their employers, and their employers are reimbursed by the government. They're effectively running the unemployment insurance system through the companies. That's a bet that creates a more sticky employment relationship. I am not sure that is really going to happen. In the United States, where you furlough employees and they go on unemployment insurance, it's relatively easy to call those employees back. I don't think if Disney World wants to reopen, it's going to delay its opening because it can't find its furloughed employees and get people to work in its park. So I'm not sure there's a difference between the public finance system in Europe and the United States, one of which gives money directly to employees, one of which gives it through employers. I think there may be a difference, though, in institutions, the role that labor unions, tripartite bargaining, and the like play, in which case in Europe, it might do a better job of protecting employment. In the United States, though, it might do a better job facilitating reallocation, and reallocation may be a very important part of what's going on. But to me, that's still an open question. Question 3, and I'm now done with the OECD data. Here it's a little bit hard to see. I'm not sure if my mouse is showing up when I share screen, but in April in the United States, we saw far and away the largest increase in disposable personal income that we've ever had. We saw the largest decline in personal consumption spending than we've ever had. The increase is exaggerated a little bit because the stimulus checks all hit in the month of April. But in general, it appears that for most of the advanced economies, in the second quarter of this year, disposable personal income will be roughly unchanged or increase from where it was at the end of 2019. That is truly remarkable. A recession, the worst that we've had in many of these countries in 80 years, combined with household income going up. Now, household income's not going up for all households. In the United States, for example, there's too many households that are left out of the programs because of their immigration status. There's a lot of suffering, long lines of food banks, and to do things like nutritional assistance to protect those who are falling through the cracks is really important. But overall, you see income up, spending down. Now, if you try to decide whether that's a supply or demand shock, you might be tempted to look at inflation. And core inflation in the United States has been negative for 3 straight months, the first time ever been negative for 3 straight months. And there are only 9 other times it's ever been negative since the 1950s. You see similar things with inflation around the advanced economies. Normally, this would be a good test of a supply or demand shock. In this case, I don't think it is. The reason I don't think it is because I think that consumer price indexes right now are very biased downward by 3 factors. Number one, the smallest of them is a shift in the consumption bundle. People are spending more money on things whose prices are going up, like food at home, and less money on things whose prices are going down, like gasoline and air travel. So if you did a chain type price index, the inflation rate would be a little bit higher. Second is the disappearing goods problem. There are a lot of things that you couldn't buy in the month of April and May that you could buy earlier. In effect, the price of those rose to infinity, but the BLS didn't record it. The statisticians aren't recording it as the price rising to infinity. If they did, you would see a lot more inflation. Third is a quality issue. I don't interpret the change in consumer spending as a change in the taste of consumers. Consumers always wanted to go to restaurants and not get a deadly disease while eating in the restaurant. That was consumer taste last year. That is consumer taste this year. Last year, it was relatively cheap for a restaurant to produce a meal that came without the prospect of getting a deadly disease. This year, it's become much more expensive to produce a restaurant meal without the prospect of a deadly disease. In theory, and I'm not saying any statistician could actually do this, in theory, you'd want to do a quality adjustment. If the price of a meal goes from $10 to $9, but the meal used to not have COVID, and now the meal has a chance of COVID, once you do the quality adjustment, prices on a quality adjusted basis have actually gone up, not gone down. So these 3 biases mean I'm not quite sure what I think has happened to inflation in the last 3 months. My working hypothesis would be the COVID shock itself was a combination of supply and demand, but it was combined with a massive, massive fiscal stimulus, as well as a large monetary stimulus. And so the net effect of the COVID shock plus public policy has neutralized much of the demand shock, leaving us mostly with a supply shock. There's still some demand shock because you're worried what's going to happen to your income in the future, what's going to happen to your job. I don't think it's totally out of the woods. Finally, the 4th question, the IMF, as we all know, stands for it's mostly fiscal. I will now show you, for the first time in my discussion, some numbers from the IMF, but unfortunately from the fiscal monitor of the IMF. These are debt to GDP at the end of 2020. It shows what was forecast in October. Where 2 G7 countries were going to have debt to GDP above 100. It shows the latest forecast where 4 of the G7 countries, the majority of them, including the largest G7 economy, the United States, are going to have debt to GDP over 107. What does that mean for our fiscal future? To put up the busiest and most complicated slide and try to do it very quickly, we all know the debt sustainability formula. I'll just pick one of these numbers, which I think for the United States is the most relevant. I think there is no reason to think that the United States would not be comfortable at a debt to GDP ratio of 150%, based on the experience of Japan, even based on the experience of some of the European countries. I think 150% would be a completely reasonable place for the United States to try to stabilize at. If growth rate exceeds the interest rate by 1.5 percentage points, which I think is perfectly plausible, when a lot of the secular stagnation forces, like a decline in the demand for investment, increased supply of savings, lower productivity, will, if anything, be more exacerbated in the post-pandemic period, putting downward pressure on interest rates, then we could run a primary deficit of 2.25% of GDP. That's some ways from where the primary deficit is right now, so it would require a fiscal adjustment, but a fiscal adjustment on the order of 1% of GDP, something that is relatively doable. Other countries, especially that don't borrow in their own currency, like Germany, France, and Italy, probably need to have lower debt, so they might need primary deficits of 1.5 or 1. The good news is most of those countries are relatively close to that target already without a lot of fiscal adjustment. So in summary, I'd say on the fiscal side, it's still an open question. My view is different countries can afford to stabilize at different places. Most countries are within about 1 percentage point on their primary balance from being able to stabilize there. If the growth rate is 1.5 percentage points above the interest rate, there's obviously risks around those forecasts shown in the last panel. So just would end by saying thank you to the IMF for producing such an excellent outlook. I learned so much from all of them. With such a rapidly changing world, I'm probably learning even more now.
Thank you so much, Jason. That was great. John, I'll give you maybe a minute to respond if you want, and also to think about what type of shape the economy recovery looks like, because we have a question from Alan Wang on that.
Okay, let me thank Jason for the discussion. I really cannot take issue with anything that he has said. I think the considerations on inflation are really intriguing. It's something, yeah, I think it's something we're going to be discussing for a while, but those points are quite relevant. Let me just say on the fiscal that, of course, that's where we were last year. We're going to have to see, particularly if the slog is long, you know, how countries will be able to manage the trade-off between, you know, keeping support to the economy and you know, and dealing with the potential period of market nervousness. Again, I don't have in mind the US, but given, you know, the breadth of our mandate, many other countries, that is going to be something that we're going to have to think about. And again, a lot, I think a year from now, we will have, I think some of the sources of uncertainty have more of a time stamp on them. I think particularly, you know, the second waves will know this winter whether we're going to see a second wave or not. We'll know much more about vaccines, you know, and I think we can do conditional forecasts now. And of course, the thing is that a lot of the policy advice, not so much the one we've given so far, but the one going forward, particularly on easing resource reallocation across sectors and all that, depends crucially on policy adapting to how the world will shape up on the pandemic front. Because we all hope, certainly, you know, people like me that love travel, that love restaurants, that love social engagement, you know, are praying that we're going to go back to something, a resemblance of what was a pre-virus normality. But, you know, again, I think those considerations are going to be quite important. The last thing I will mention on the shape of the economies, I was thinking for those sectors, you know, say the pandemic turns out you're able to contain it. You find a vaccine even more quickly than expected. But all wonderful, but there may be structural shifts in the economy that, say, a shift away from traditional retail that was already occurring, that may have received sort of a final push, if you want, from, at least in certain sectors, from the pandemic. So you may, even if you, in a sense, under a very optimistic scenario, that you're able in some ways to go to a status quo ante in terms of social distancing, there remains a question as to how the shock itself could still have affected the shape of the economy going forward, maybe positively on the digitalization front, and but potentially in a quite costly way for some employment categories. Let me stop here and happy to take other questions.
Thank you, Gian Maria. I'm afraid we'll have to move on to Wenjie Chen. Wenjie, you're presenting Countering Future Recessions in Advanced Economies. Please, take it away.
Thank you very much, James. And I want to thank GW as well for hosting us again on presenting the Rio chapter. So let me get up my slides. I hope you can see them. And today I'll be presenting the first one of the two analytical chapters. And this one, as James was saying, is on countering future recessions in advanced economies, cyclical policies in an era of high debt and low rates. And I also want to acknowledge that this chapter was written by a big team, and some of whom are joining the conference here and hopefully can join us later on the Q&A session as well. When we certainly started this chapter last year, we did not envision that a recession would materialize so soon. And as we know now, the world is struggling with the health and economic effects of a profound new crisis caused by the COVID-19 pandemic. Governments and central banks all over the world have introduced very strong discretionary fiscal and monetary measures to counteract this economic fallout. But as the pandemic is still unfolding, even larger measures may be forthcoming. Because the analysis of our chapter was largely completed before the outbreak of the pandemic, many of the findings and recommendations, while not directly applicable to the current shock, are still relevant and can help ensure the eventual recovery against future adverse shocks and bolster economic resilience going forward. So, advanced economies entered this crisis with historically low interest rates, you can see on the left, and high public debts. These conditions are most likely to persist in a post-pandemic world as well. So then this raises concerns that policymakers may be more constrained. So what options will they have when a future recession hits? And this chapter tries to get at this question the following way. First, given low interest rates in advanced economies, conventional monetary policy is limited. Drawing on the literature here, we review a few unconventional monetary policy options they used during and since the GFC, and possible side effects and trade-offs in their use. And then the second part, given high debt levels, we look there at how recent low interest rate growth differentials, which Jason mentioned before in his discussion as well, have affected fiscal constraints and what those implications are going forward. Lastly, given the constraints on conventional monetary policy, we look at how fiscal policy can best be implemented to counter future recessions in a timely and effective way. But first, let's take a look at the unconventional monetary policy. And here again, I reiterate that we rely exclusively on the large literature in this field, and we highlight here two particular policy measures in terms of the negative interest rate and also quantitative easing. Now, on negative interest rates, so far, experience has been limited to mild forms of it. However, if there were even further cuts into the negative territory, this could raise deeper issues requiring a variety of legal, regulatory, and tax law changes in some countries. On quantitative easing, or QE, which has been used more widely during the current pandemic, the experience from the GFC has been generally seen as positive, but going forward, there have been also growing concerns about its efficacy given flat yield curves and potential trade-offs, such as concerns about money finance and the loss of the central bank independence, among others. So given these uncertainties and concerns about monetary policy, fiscal policy will need to play an important role in responding to future adverse shocks. At the very least, however, monetary policy can be accommodative during a recession and support fiscal policy. But given the high debt levels, what's the scope for fiscal policy actions? And here we zoom in on the recent developments in lower interest rate growth differential. So instead of the G minus R that Jason had before, we look at the R minus G. But in this context, what we really focus on is a country's borrowing capacity, and in particular, its public debt to GDP ratio. And here, what we focus upon is we run a simple thought experiment. Using accounting identities, we decompose this debt into key fiscal variables. We calculate the government debt ratios for 30 advanced economies, and what would have actually evolved if the 2015 real forecast for nominal interest rates, nominal growth rates, and primary deficit ratios had been correct. Comparing this counterfactual then to the 2018 actual outturns measures the impact on debt of news about these variables. As seen then in the left chart, we compared to the forecast the actual outturns, and you can see here the nominal growth since 2015 has been higher than expected, and primary deficits smaller. Government interest rates have also fallen, although the magnitude here and sometimes the sign of those changes varies by country and debt maturity. As shown then in the right chart, the red line here depicts changes to interest rate growth differentials, and they have indeed slowed debt growth in the last few years relative to what was expected for many countries. But in most cases, this effect is relatively moderate. So, however, on the other side, what you can see here that, in fact, primary deficits have contributed more in terms of slowing down debt dynamics for many of the countries, as depicted by the blue line. In summary, many countries have experienced modest savings from lower interest rate growth differentials, but news about primary deficit ratios has actually played a larger role in determining outstanding debts. The total effect of these two forces, which is shown in the yellow line here, shows you that, in fact, both have contributed to some easing of the borrowing constraints on average for many of these countries. And in the chapter, we also offer more analysis in terms of the persistence of low R minus G, and also what the likely correlates underlying these long-run trends might be. So again, on average, countries' ability to service debt have improved their debt dynamics. However, there are, of course, country-specific vulnerabilities to shifts in market sentiments, which we have abstracted from in our analysis. So overall, it will be even more important, therefore, to use fiscal instruments more carefully. So then the question begs, which fiscal instruments, meaning the delivery of fiscal stimulus here, is the most effective way? And the summary of a vast existing literature suggests of a fairly wide range of fiscal multiplier estimates. The takeaway here is that public consumption and public investment multipliers are biggest, whereas tax and transfer multipliers were found to be lower. Well, that's mostly due to uncertainties, also in terms of the identification issues. But what's also important is the fact that apart from the choice of the fiscal instrument, the macroeconomic context in which they operate also influences the effectiveness as well. And that's where we're going to turn next. So what we did here is we estimated fiscal multipliers under different conditions with a particular focus towards understanding how they vary with economic slack and the monetary policy stance, both of which would be critical in future recessions. Now, as seen on the left-hand side chart, when there is economic slack, in particular measured by labor markets, see here below or above mean unemployment rates relative to a country's own, fiscal policy tends to be more powerful. And as seen in the right-hand side chart, when monetary policy is accommodative, that means it does not tighten in response to fiscal stimulus, the fiscal multipliers tend to be larger. And these findings all point out how powerful, in fact, fiscal policy can be in responding to another recession when there would be slack and accommodative monetary policy. But how best should it be implemented? Are discretionary actions or automatic stabilizers preferred? And a key argument in the past has been that against over-reliance on discretionary fiscal policy actions to counter the cycle is that they tend to be delayed. In contrast, established automatic stabilizers can begin acting against an adverse shock immediately. So let's look into this in more detail here. And what we have done, in fact, is we looked into recent proposals for strengthening automatic stabilizers. And the first set here are traditional automatic stabilizers like the tax code and unemployment benefits. But recently, there have been also proposals that have been more direct at macroeconomic stabilizations. And there, they have suggested, in fact, to link a portion of government spending explicitly to the state of the economy. And Jay has worked quite extensively on this and will be able to later give us some of his views as well in his discussion. So for instance, one of the more explicit proposals has been when unemployment rises above a certain threshold, we increase public spending automatically. And this we refer to as the rules-based fiscal stimulus in our chapter. And to see what its general effects are, we actually build it into our workhorse IMF G20 model and find out the implications of incorporating this asymmetric response of a trigger-ready fiscal stimulus linked directly to the state of the economy. So what do we find? Well, the model results suggest that rules-based fiscal stimulus can be extremely effective, particularly at the effective lower bound. So first, you can see here 3 different responses of the real GDP to a negative demand shock experienced by a representative advanced economy. So in the first case here, what I'm showing you with the blue setup, monetary policy is able to operate fully, and interest rates is away from effective lower bound, then real GDP drops by the least amount out of those 3, and then gradually converges back to its trend path. However, if the economy is, in fact, at the effective lower bound and monetary policy is unable to react, then there's a large and persistent drop in GDP, as you see by the red line here, to a response of a shock. And in both cases here, I want to highlight that the traditional automatic stabilizers have been included and calibrated to the current sensitivities. And now we put in the rules-based fiscal stimulus. And in this situation, what you can see, and how do we put it in? First of all, we draw upon some recent work by former Fed economist Claude Gian. This rules-based fiscal stimulus is calibrated so that the unemployment rate rises by 0.5 percentage points above its natural level. That will trigger automatically in the model a large targeted transfers to liquidity-constrained households, equivalent to 0.7% of GDP. So as shown here then by this gold line, you can see the drop in real GDP after that demand shock at the effective lower bound is markedly smaller compared to the red line. However, it's still below the blue line when monetary policy is fully in effect. However, of course, the stabilization achieved by the adoption of rules-based fiscal stimulus does not come for free. There are fiscal costs. And so let me turn to those.
Okay, Wenjie?
Yes?
Yes. We have a little more time. Continue.
Okay. So across these scenarios, fiscal deficits and public debt to GDP rise after negative demand shock. And you can see here again with monetary policy in full effect, away from the effective lower bound, we get the least costly outcome. And the red line here is when you don't have the rules-based fiscal stimulus. And the last scenario I want to highlight here is, in fact, when you do have this automatic response with a very generous transfers to liquidity-constrained households, although the fiscal deficit goes up by more at first, on impact, the debt, in fact, on the right-hand side, public debt to GDP ratio is actually better, I see by the yellow line, compared to if you don't have the rule in place. And that's because in this case here, because of the spending, you're stimulating the economy, and then the overall GDP path is better. So therefore, in the denominator, that overall larger GDP reduces overall debt to GDP. And there are more benefits. In fact, when we run this through a stochastic simulation model, what we find is also that having the rules-based fiscal stimulus in place reduces the probability of a recession. And you can see here, I'm not going to go into detail because of time constraints. On the right-hand side, the different bars, when you have monetary policy in place that's effective, by the blue line, you get the lowest probability. But on the yellow bar, you can see when we have the rules-based fiscal stimulus, it's actually fairly close. Whereas in the red bar, when we don't have the rules-based fiscal stimulus, you get the highest probability of recession. So to conclude, scope for further interest rate cuts is limited. However, there are some possibilities with unconventional monetary policy tools that could be deployed, but framework changes might be needed in going forward. However, they can still support fiscal stimulus in a recession. Now, countercyclical fiscal policy will be key to counter future recessions. And what we found here is in that many economies, recent developments have relaxed budget constraints, although the role of R-G is relatively small compared to primary surpluses. However, in our results, and you can read that further in the chapter, we find that low R-G is likely to persist also in the future. In terms of which instrument to use, we find that public spending stimulus is most effective fiscal response to a negative shock, and even more so when there's economic slack and monetary policy is supportive. And lastly, how to use it here in our model, we show that rules-based fiscal stimulus can be very powerful in countering a recession when monetary policy is constrained at the effective lower bound. And having it in place can also reduce uncertainty because firms and households can plan ahead knowing the government will have strong countercyclical measures in place before a shock occurs. And being tied to macroeconomic condition also means that the fiscal stimulus can stop in time when conditions improve enough or will last longer as dictated by the data. So therefore, using rules-based fiscal stimulus does not preclude, in fact, the use of discretionary fiscal stimulus. Now, while these recommendations cannot address a shock that has already happened, such as the current pandemic, I think it's important that developing and putting them in place now could help ensure the eventual recovery against future adverse shocks and bolster economic resilience going forward. Thank you very much, and I look forward to Jay's comments.
Yes, Jay, our local man of the hour on automatic stabilizers.
Great.
Turn to her.
Great, thanks very much. So I'm having a little technical difficulty, so I'm coming to you from a phone, and thank you to the IIEP staff who I think are about to share my slides for me. And if not, I'll just start talking and hope that'll come up soon. So first, let me just say, I admit to being a somewhat biased discussant here in that I am a big fan of automatic stabilizers and have been something of an evangelist for them for the last couple of years. But even that being said, I really like this paper, and I think it's quite well done. So why don't we just jump right into the first slide? So I think this is a really interesting and potentially extremely important piece of work. So on its own, I think it makes a nice contribution, but I think it coming from the fund is important. And I think this key message that I want to focus on here, I really commend the whole thing to you. I think Wenjie walked through the pieces on monetary policy and fiscal space. I think they're really interesting. I want to focus on some of the analytical results they have about showing that robust automatic stabilizers can substantially help the economy if you're at the effective lower bound. And in fact, they're the fiscally responsible thing to do. And so why don't we go to the next slide? And I'll just jump to this figure that Wenjie was just showing you that I really enjoy, which is it's showing you that countercyclical fiscal policy. So on the next slide, countercyclical fiscal policy can basically get you out of the bad outcomes that come from hitting the zero lower bound. Can we click to the next slide?
My apologies, it's frozen. One moment.
It's frozen. Okay, well, I'll keep talking. So you saw the figure a moment ago that's showing that countercyclical fiscal policy can basically get us out of the bad outcome of the effective lower bound. So in a normal recession, you take a hit, but then monetary policy responds, and you know it's not that bad is the hope. But at the effective lower bound, their model shows you facing a much worse outcome. But when you instead have this automatic stabilizer in place, you're really close actually to as if you had monetary policy. But on the next figure is the one that I think really is more surprising to people. It might not surprise you to say, hey, if you spend more during a downturn, the economic outcome won't be as bad. But what's really, I think, even more interesting here is it's saying that the debt outcome is better if you do so. And so even though you're spending more in the downturn, you wind up with a better debt to GDP path. And so in this case, even if you don't care about the economy, you don't care about people, you don't care about the costs of being in a recession, just from a fiscal conservative perspective, just from wanting to minimize your debt to GDP levels, you should go ahead and do aggressive countercyclical fiscal policy, preferably with an automatic stabilizer. And so I think that's what we see here. So on the next slide, if you say to yourself, well, what's going on here? I mean, what it really is multiplier arbitrage. And I think that's a phrase I hope we all start using more because it's really important here. So you're going to expand spending when a multiplier is 2.5, and then you're going to rebalance your budget deficit when the multiplier is 0.5. So you expand at the effective lower bound, and then you bring your economy back into fiscal balance on the deficit side once it's no longer very costly to do so, and once the central bank has the capacity to respond to any of the impacts on the economy from the cuts that you're making. On the next slide, just I think an important thing, as Wenjie mentioned, they talked some about fiscal space in this paper, and I think quite frankly nicely acknowledged the fact that we don't really have a clean vision of how much fiscal space a country has sometimes. And so I think it's important to flag here, if you use just your standard kind of debt sustainability equation, that R minus G is multiplied by the prior debt stock. And what that means is boosting growth in a downturn is even more important when debt levels are high. And that's actually the opposite of the advice that countries often get. They're told, well, if you had more fiscal space, then you could spend during this downturn, but because you don't, you're going to have to be conservative on your fiscal policy. The logic of this paper and just of a debt sustainability equation says that's actually backwards. If you have no debt, kind of trying to stimulate the economy might be good for people and the economy, but it doesn't do anything different to your debt stock. Whereas this is highlighting the fact that the higher your debt stock, the more important it is to preserve growth and to prevent a sustained recession. So on the next slide, I just want to highlight why it's so important what the fund says. There's a paper by Romer and Romer that's cited in this chapter that notes that policymakers really do act differently when they have higher debt levels. They behave as if they are constrained by not having enough by not having enough fiscal space. And actually papers like this, and if the IMF were very forthcoming in its advice saying you need bigger automatic stabilizers, maybe we could get policymakers to not make this mistake. On the next slide, I just want to emphasize quickly why automatic. There are three main reasons. They turn on faster, easier implementation, and they don't turn off too soon. And I think in the paper, there's a little bit more of an emphasis on this, they turn on faster piece. I would like to note, if you look at another picture in this paper, you do see the United States, who has the worst automatic stabilizers in the advanced economies, actually did more during the Great Recession because of an aggressive fiscal response, maybe because people like Jason were helping run the fiscal response at the time. But you've also seen it again this time around. The United States has been very aggressive on discretionary measures. And so I think one of the questions is it just the fact that it turns on faster? Because if so, people might say, well, as long as we're willing to do it on a discretionary basis, we don't need the automatic stabilizers. But I think on the next slide, you see this other core reason, which is in the United States, this is showing you the purple line is a measure of the fiscal impulse in the United States. The orange line is what you might guess it would do based on the economy. And you see in the Great Recession, the US had a big fiscal stimulus, as much as you would have guessed based on the economy. But coming out of the Great Recession, the US went into big austerity or really cut back. And that's far more than you should have given the economy. And so proper automatic stabilizers would have prevented this from happening. And we may see a replay of this in the United States right now, where we've had a big rush and now we're facing a series of fiscal cliffs. And the question is, will Congress actually continue the support? If we had done everything in these last few bills with automatic triggers in place, then we wouldn't need to worry about that. I'll just wrap up really quickly by saying the paper models a specific way of doing automatic stabilizers, effectively direct checks to people. I would just say there are lots of other things you should do. And in fact, I think one piece of advice might be to put countercyclicality into as many things as possible, whether it's employment subsidies, whether in the United States, it's really important to have state and local government subsidies happening. A proposal that Jason wrote for us in this book, Recession Ready. But there are a number of things, and I would just suggest people kind of think of doing as many as possible. So just to conclude, I think it's a really interesting paper, really happy to be here to discuss it. And I hope, frankly, that the IMF takes its own advice here really seriously and pushes the idea to countries that they need more robust automatic stabilizers, and they need to really push and make sure they don't let fear of debt stop them during a recession from doing countercyclical fiscal policy. And I'll stop there.
Thank you so much, Jay. I'm sure if you've stepped on Wenjie's feet, because it sounds like you're all singing the same tune. So I'll just move it on from here. We have one question, Fred Jutz, but I'm going to delay that till afterwards and get on to the final session. We're running a bit behind. The next session is on emerging markets. And before either of our speakers speak, I will put forward a question from Vikram Nehru, which is an unusual thing to do. What can you say about the growth of debt burdens in developing countries? What would this mean for future developing country long-term growth? Could you differentiate your answer by region? So I thought I'd start with that to get you thinking. Now, Katharina, Niels-Jakob, your floor.
Perfect. So without further ado, let me start. As James said and introduced us, our chapter is on emerging markets. And more specifically, we're looking at global financial shocks to emerging markets. And we look at macroprudentials and how they can help to dampen those shocks. So this is joint work with my colleague Niels-Jakob, who will also speak on parts of this chapter. And it is also joint work with Francesco Grigoli and Damiano Sandri, who was our team lead. So let me jump right into our research question and the content of this paper. So to set the stage, we're speaking to the very fast literature that shows that global financial shocks can severely affect emerging markets. So emerging markets therefore would like to absorb these shocks naturally, and exchange rate flexibility alone appears to be insufficient for this. So naturally, emerging markets ask themselves which tools they could use in order to help them dampen these external shocks. And in this chapter, we really want to focus on macroprudential policy measures as a tool to dampen shocks to emerging markets. So more specifically, we will focus on several questions, but the questions here in bold will be the questions we will be answering today in this presentation. So first, we will show whether a high level of macroprudential policy can buffer the effects of global financial shocks on GDP growth in emerging markets. And secondly, as a potential channel for this, we analyze whether macroprudential policy can also entail more monetary independence for emerging markets that use them. So let me start by showing you some graphs about our sample and the data we're using in the following analysis. So on the top right, you can see external financial conditions that emerging markets are facing. This is what we will use in our analysis as our shocks to emerging markets. So on the left, you can see two series. The blue line is the US rate, which we will use as our risk-free rate. And as you can see, it is adjusted for unconventional monetary policy below the C or lower bound. And the red line is the VIX, which will be our proxy for risk premium. On the right, you can simply see the net capital inflows, the mean and the interquartile range, And this will be our measure of the quantity of the supply of foreign capital to the emerging markets. So now going to our sample of these 38 emerging markets, on the bottom left, we can see their average GDP growth. And we can already spot that in line with the literature, we can see a co-movement between those external factors and the economic outcomes in our emerging markets. And on the bottom right, this will be the core of this chapter, we'll see the level of macroprudential regulation. And here you can see an index of the stringency, how high macroprudential regulation is. You can see, first of all, that the level of macroprudential regulation broadly has increased over the last 20 years that we're analyzing, as well as you can see a high variation between the countries that we're analyzing, reflected by the wide confidence bands. So going to our first question, can now this level of macroprudential regulations buffer the effects of global financial shocks on GDP growth in our emerging markets? So we want to analyze this obviously a bit more formally than these graphs. So we run the following panel regression. On the left-hand side, we have quarterly growth of real GDP. And on the right-hand side, as the independent variables, of course, we have our shocks. So we have the shock to the US rate as our shock to the risk-free rate, the VIX as a shock to the risk premia, and we also have net capital outflows as shocks to foreign capital supply. And in order to alleviate concerns about endogeneity, we instrument net capital outflows from one country with the net capital outflows to the other countries in our sample. So those are our three shocks. Also on the right-hand side, of course, we have the level of macroprudential regulation. So what we really want to focus now in this regression is gamma, which is the interaction now between the level of macroprudential regulation and our shocks. So we really look at how the effect of the macroprudential of the shock on GDP deteriorates at the given level of macroprudential regulation. Of course, we also control for a wide set of control variables, such as country fixed effects and also country time varying variables. And as you can see, because we do expect decreasing marginal effects of MPMs, we also repeat the exercise for the squared terms of the macroprudential regulation. So let me jump right to our main findings. This slide shows our main results. So we show here the coefficients added up, the coefficients of the macro of the shock, but also of the shock interacted with the macroprudential regulation. So basically, these graphs show the response of GDP to a specific global financial shocks, but now in function of the level of the macroprudential regulations that the countries have. So the first graph shows an impact of a shock to the risk-free rate, to the US rate in our specification. We can see that these macroprudential policies do not significantly dampen a shock coming from the risk-free rate. However, you can see in graph 2 and 3 that we can indeed see that at certain levels, medium to high levels of macroprudential regulation, this can dampen a shock of the VIX, of risk premia, and also of capital outflows. So at some point, you can see of macroprudential regulation, these shocks become insignificant as an effect on GDP. And graph 4 also shows you the distribution of macroprudential regulation in emerging markets. So you can actually see that these levels of macroprudential regulation, where the tools can actually help to dampen the shocks, are present in our data set. So these are not extraordinary high levels that no country has. This applies to several countries in our sample. One concern you might have now is that the correlation of macroprudential regulation and the external shock is only driven by specific macroprudential regulation. More specifically, one could worry that macroprudential regulation targeting foreign currency exposure are the only ones driving our results. Thankfully, the granularity of the data allows us to distinguish between different forms of macroprudential policies. So we rerun this regression with different kinds of tools individually, and we find that the effect is significant for a broad set of tools and not just the tools related to foreign currency exposure. As a last question, we ask whether this effect is symmetric. So in this exercise, we often think about macroprudential regulation dampening negative shocks and therefore helping a milder recession. But in that case, you might say, okay, more macroprudential regulation is always better. However, we see in this, I'm sorry, this skipped. However, we see in this slide that the effect of macroprudential regulation is symmetric. Therefore, yes, macroprudential regulation can dampen a negative shock to GDP, but it can also dampen the positive ones. So long story short, as with many things in economics, there's no free lunch, also not with macroprudential regulation. So let me now pass to my colleague, Niels-Jakob, who will focus on a potential channel, namely monetary independence.
So thank you very much, Katharina. So Katharina has just provided you with evidence supporting that a higher level of macroprudential regulation can help smooth the GDP volatility. So let me now turn to the question about whether a higher level of macroprudential policies can allow countries to conduct a more counter-cyclical monetary policy in response to global financial shocks. This could indeed be one channel through which the more stable growth path is achieved. Next slide. So to motivate this question, let me begin by reminding you of the policy trilemma in international macroeconomics. According to this trilemma, countries with an open capital account and flexible exchange rate should retain monetary independence. Nevertheless, there is evidence that even countries with flexible exchange rate conduct a pro-cyclical monetary policy with respect to global financial shocks, possibly to stabilize exchange rate and financial flows. Specifically, there are studies that have found that EMs tend to hike policy rates when global financial conditions tighten, which works to make their monetary policy response pro-cyclical. So what we do in the chapter is that we investigate if a higher level of macroprudential regulations can allow EMs to conduct a more counter-cyclical monetary policy in response to global financial shocks. The idea behind that hypothesis is that by creating a more resilient financial system, macroprudential policies can allow monetary policymakers to focus more squarely on inflation and output, and thus make the policy more countercyclical. So to investigate the hypothesis, we will regress domestic policy rates in EMs on a set of global financial shocks. That's the S vector, and these shocks include the US policy rates, the VIX, and net capital outflows instrumented the same way as Katharina explained you above. And we will then interact the shocks with the macroprudential stance to allow the monetary policy response to depend on the level of macroprudential regulations. If a higher level of macroprudential regulation indeed gives you more monetary independence, then we should see a significant and negative gamma coefficient. And in the regressions, we also control for domestic conditions. Next slide. So in this slide, I show you the estimated response in the policy rate to global financial shocks as a function of the macroprudential level. According to the equation that I showed you before, the estimated policy response to a shock would be beta, that's the direct impact of the shock, plus gamma times the macroprudential level, that's the interaction terms. So in chart number 1, you see the estimated policy response to an increase in the US rate as a function of the macroprudential levels. And for a low level of MPMs, you see that countries tend to increase their own policy rates in response to an increase in the US policy rate. However, this estimated increase becomes smaller and smaller as the level of macroprudential regulation increases. In chart number 2, you see a similar picture for an increase in the VIX. For a low level of macroprudential regulation, you see that countries tend to hike their policy rates in response to an increase in the VIX. But for a higher level of macroprudential regulation, countries actually tend to decrease their policy rate in response to an increase in the VIX. And in the third chart, you see that the interaction term is insignificant for an increase in net capital outflows. And in chart number 4, I show you the distribution of MPMs for the EMs in our samples. And you see that in 2016, a substantial part of our sample had a MPM level that around 20 in our index, which means that their policy rate should more or less be insulated from these US policy rate shocks above, and also that they can tend to decrease their policy rate in response to a big VIX increase. Taken together, the evidence here suggests that a higher level of macroprudential regulation can allow EMs to conduct a more countercyclical monetary policy in response to fluctuation in global financial conditions. Next slide. So let me now conclude by reminding you of the questions that Katharina posed to you in the beginning and the answers that we have provided throughout this presentation. First, we asked whether macroprudential regulation in fact can provide buffering against the effect of global financial shocks on GDP growth. And here the answer that we provided is yes. Katharina showed you that EMs for a sufficiently high level of macroprudential regulations can insulate themselves from global financial shocks. And this is not driven by any specific MPM measures. Indeed, Katharina showed you that the result is found for a range of MPM measures. Does this mean that a high level of MPMs is always better? No. Katharina also showed you that a higher level of macroprudential regulation is not a free lunch. Indeed, it also tends to lower economic activity when global financial conditions are favorable. Second, we then asked whether enhanced monetary independence can be one channel through which this more stable growth path is achieved. And here the answer that we provided is also yes. I showed you evidence that a high level of MPMs give EMs additional monetary independence in order to conduct a more counter-cyclical monetary policy in response to global financial shocks. In the chapter, we also go into other questions, but in the interest of time, let me stop here, and I look forward to the discussions and your questions. Thank you.
All right, Sunil, take it away.
Okay, the few minutes that I have, I'm going to assume in some sense that chapter 3, which is focusing largely on monetary policy responses, is in some sense the policy implication that you're trying to get at is true. I mean, in the sense, I think this chapter has been overtaken by events in the sense that this was probably written in February before the ferocity of COVID-19 became obvious. So I'm going to take a much bigger, larger systemic view to try and argue about the challenges that COVID is actually posing for emerging markets, and not just in terms of the monetary policy response. But that said, I think that what the chapter is trying to convince us that if you have a well-managed financial system that uses appropriate macroprudential regulation to contain systemic risk, it's better placed to dampen the effects of global and domestic financial shocks on GDP growth. Now, this can be done through credit availability. It can be by having a more sturdy and credible exchange rate, and that it enhances the ability of monetary policy to lean against these shocks. Now, I have no dispute with that sort of policy implication. My only question that I had when I was trying to understand the paper is that this whole notion of tightness of macroprudential policy. To me, countries have a base level of regulation, and then they utilize macroprudential policy as needed when systemic risk starts increasing. So in that sense, tightness and looseness of macroprudential policy is actually related in some sense to the underlying level of systemic risk. So I was not really clear as to how to interpret this tightness and looseness of and the cumulative nature of this macroprudential policy. But anyway, that said, I think that the implication is clear. Now, let's talk about the COVID-19 crisis and emerging markets. This is really, in some sense, a truly global economic crisis, and at the same time, a societal shutdown. Right? We've got a crisis in the labor market where we need to have social distancing, or we have to have a complete lockdown. The other thing is that depending upon how the virus spreads, global revival cannot be necessarily synchronized. It'll depend upon how countries are situated, a la the virus spreading. And the last thing is that financial stress is in some sense induced by this global shutdown and societal shutdown. And as the stresses mount, we yet may get a financial crisis or a financial breakdown. Now, So what's required in some sense is not just the focus on the financial sector, but here we need a much larger, broader focus on economic resilience rather than just on financial resilience. Because here, the financial stress is in some sense induced by the stress in the economy as a whole. So I think the focus of policy has to be on economic resilience, and that on the health of the households, on the health of the firms, on the health of governments, and of course, the health of financial intermediaries. Now, what are the challenges? Why is this COVID-19 crisis different and so much deeper and much more difficult to handle than more traditional economic and financial crises? Now, effectively, what we're trying to do is we are trying to put economies into comas, right? We're just trying to shut down the economy. Shutting down the economy means that in some sense, we're trying to put private contracts and private relationships among private agents to be held in abeyance. We are then bearing the cost, hopefully, for holding this in abeyance, and that we hope that when activity returns to normal after the health crisis has been sorted out, we will then allow market and legal forces to start working again. Now think about the trade-off that involves. It basically says that countries that don't have a lot of resources, emerging markets, developing, many of them emerging markets and developing economies, they have to make a choice between how long they can sustain a lockdown, even a partial lockdown, because the cost of that has to be borne socially, and then think in terms of opening up. If the country doesn't have the fiscal space, if it doesn't have the resources, it's entirely possible that we may think of opening up a bit too early, which if then it creates a health crisis again, will complicate the return to normality. So in some sense, the costs are clear. On that trade-off between lockdown and opening up, countries that have less resources are going to have a problem. The second thing is the complexity of the interconnectedness and the uncertainties. So a variety of questions are being raised, which we in some sense are not prepared for. How do you maintain the welfare, the well-being of households, at the same time provide support to firms and intermediaries? That's the cost. If you can bear that cost, you can be under lockdown for a much longer period, you can sort out the health crisis, and then restart the economy. Should the contracts be renegotiated and possibly temporarily modified for the duration of the shutdown? How should the state target interventions to make them temporary, targeted, transparent, and at minimum cost? And these are very, very challenging microeconomic questions, which does the state have the administrative capacity to do so? Is the legal system up to the job? Can society elicit the collective will to make shared sacrifices to tide over the pandemic? Very, very important issues. And what is the success dependent on? It's dependent upon state capacity, quality of institutions, it's dependent on social trust in government, and it's dependent on effective leadership. Now, for emerging markets, the way I've conceptualized the crisis is even more difficult. Why? Because poor countries, crowded cities, weak health systems, and very, very, and this is very important, large informal sectors. So, in fact, you can see, we've been seeing images of Indian migrant labor walking back home with children and belongings, without food, without shelter. This has created a huge crisis in terms of a welfare crisis for many of the emerging countries. Now, so that's the nature of the challenge that we are facing. Now, emerging markets, the issues are compounded by the mother of all sudden stops in capital and resource flows, right? Capital outflows, we especially seen very large portfolio outflows, the largest we've in recorded history, dramatic fall in remittances, a breakdown of trade and disruption of international supply chains, and a collapse of commodity prices. I mean, that's an external environment which many of the countries now are going to find it very, very hard to deal with. And I think that what the chapter says that countries that have a better financial system, a stronger financial system, are going to find it easier to deal with economic resilience because the financial resilience is there. Emerging markets still face a lot of headwinds, and many of them being mentioned earlier. Restricted fiscal space, inability to do QE because of effects on the exchange rate, limited ability to borrow in local currency, high risk of debt distress for many of those which are highly indebted, a paucity of FX reserves in some of the countries, and of course, longer term, the prospect of anemic global demand and a shortening of the global supply chains. Right? So there are longer term effects that we have to deal with. Now, last few comments. For emerging markets, the liquidity crisis may turn into debt crisis. Right? So here we're trying to deal with the trade-off between lockdowns caused by a health pandemic, and at the same time bearing the cost of the lockdown, but seeing that it's cannot be the state doesn't have the fiscal capacity or the administrative capacity to maintain the lockdown, opening up maybe prematurely. So if they don't have the capacity to borrow and actually deal with the health crisis, we could get all kinds of complications.
That's a signal.
That's a signal. So the issue for the emerging markets is that with their short-term issues, and there are longer-term issues in terms of scarring, because this is probably going to lead to much higher debt loads. It's going to lower investments in basic infrastructure, erosion of human capital, breakdown in trade and supply linkages, and may lead to lower productivity and lower potential output going forward during the decade. So the issue globally has to be how the international community can provide emerging markets with the liquidity and the resources, first to manage the health crisis, and then to manage the recovery with much higher debt burdens. So I think if you read the G20 communique, they're talking about debt moratoriums, they're talking about debt forgiveness, talk about debt restructuring. So I think globally, this is going to be very important for many of the emerging markets and the developing countries. And I think that a lot of international cooperation is required to make sure that we come out of this health pandemic well, because like I said, it's not going to be synchronized. It's going to be the next 12 to 18 months are really going to be difficult. And if we have another second wave in 6 months of the crisis of the virus, then it's going to be much harder to come out of this for a very long period of time. Anyway, those are my comments.
Thank you so much. That was great. We're going to take 1 minute for a response. I think we have a lot of agreement again, and then I will keep the lines open for until 2:45 for questions. Continue. Katharina?
Okay, thank you very much for those insightful comments. I think you make some very good points about the nature of this shock, and I mean I completely agree that when you look at the COVID shock, it's not a shock that stems from global financial markets. It's a real shock that then has implications for global financial markets. So I think that's kind of the angle. I think we can say something about this through the lens of this chapter. That there will be, we have seen financial turmoil in the aftermath of the shock, and that's kind of making policymakers in emerging markets facing some of these trade-offs that the chapter speaks to. And in that sense, the chapter would kind of suggest that the more resilient financial system you have and more resilient macroprudential regulation you have in place, the more aggressive you can use your monetary policy to counter these negative impulses coming from financial shocks and thereby stabilize your economy. But I think that's what we can say through the lenses of this chapter. And of course, I mean, there are much broader and important questions about the COVID as well. I don't know if you will, Katharina, if you want to complement.
I'm just going to spend a couple of seconds on your question on the index. So your very first question was on our intuition, so why we would accumulate these macroprudential measures as our independent variable. So we decided to take the actual measure of stringency. So how high is macroprudential regulation in a country once the shock hits? So we hope to alleviate several concerns about endogeneity with this, simply because the change in macroprudential regulation might actually be a response to the shock. So you never know what happens first. So this is why on the right-hand side of our equation, we have the level that was accumulated over the last years, maybe decades of macroprudential regulation. We see how this level that was accumulated in the past helps you now in this moment when the shock hits. And we hope to show that these higher levels of regulation can help to dampen those shocks. But I hope this answers your question on our measurement.
Thank you, Katharina. I will just follow up on Vikram Neeru's question, which is still quite relevant. Do you have any of you, three of you, any insight on how the impact is differentiated by region? Open to anyone.
So we did not do this in the chapter. So this is something the regional offices might look into or not to do this for several sub-regions, but we're really looking at a broad set of emerging markets of 38. We're also looking, I think you mentioned earlier, developing, so our focus is on emerging markets, which does not include what we classify as low income, and we're really focused on these typical emerging markets, China, Russia, Brazil, but also obviously many smaller ones.
Regarding there was a question about the debt level, and I guess the only thing we can really say about this from this chapter directly is that we did a host of robustness checks, and one of the things that we tried to throw in was like gross public debt, because you may be concerned that maybe countries that have a certain level of macroprudential regulation, they also have a certain debt profile. So when you're measuring macroprudential regulation, you're maybe capturing that. We try to control for that, and it doesn't overturn the results. So in that sense, the results that we showed are robust towards the level of public debt that you have. But I think that's kind of what we can say about that question directly from this chapter.
Great. Well, let's, I see the time is just turning, so I'll bring it to a close here. Thank you so much to our speakers, to our discussants, and especially to our audience. Thank you very much. Cheers. Bye-bye.